The laundromat is the most seductive business in America. A 95% success rate, recession-proof demand, 30% annual returns. Coin-operated cash machines that run themselves while you sleep. That is the story sold by every blog, every broker, and every late-night YouTube guru who has never set foot inside one at 2 a.m. This is not a passive income machine. It is a $500,000 entry fee to a zero-margin business where the very thing that makes it passive, unattended, coin-operated, self-service is the mechanism that destroys the margin. And the industry is structurally engineered to fail on a 12-year clock. The laundromat does not make you wealthy. The laundromat consumes your capital, your time, and your sanity. And it does so gradually that most owners do not realize they are trapped until the equipment retool comes due and the math no longer works. Acquiring a laundromat is not like buying a cafe or a gas station. The economics are inverted. You do not generate revenue through labor or markup. You generate revenue through machine utilization. Every dollar that enters your building enters through a coin slot, and every dollar that leaves through a utility bill. The entry costs are unforgiving. An existing laundromat trades between $200,000 and $600,000 depending on location, equipment age, and lease terms. Building from scratch, new equipment, leasehold improvements, plumbing and electrical infrastructure runs $400,000 to $1.2 million. The equipment alone, assuming 20 washers and 20 dryers, costs between $180,000 and $400,000. A single 60-pound commercial washer from Speed Queen runs $10,000 to $20,000. A stack dryer, $6,000 to $15,000. And these are not assets that appreciate. They are engineered liabilities with a 12-year fuse. The broker will tell you the store generates $300,000 in annual gross revenue. What the broker will not tell you is that utilities alone consume between 15% and 40% of that number before you have paid a single employee, before you have paid rent, before a single machine breaks down. This is the number that kills laundromats. It is both invisible and unavoidable. Water, gas, and electricity, the three inputs that make the business function at all, consume $2,000 to $6,000 per month in a typical store. In larger operations, owners report utility bills exceeding $8,500 per month. For a store generating $20,000 in monthly gross revenue, that is 30 to 42% of the top line, erased before a single customer complaint is handled. The breakdown is revealing. Water accounts for approximately 12% of utility costs. Electricity consumes 32%. Gas, for heating water and drying clothes, accounts for 6%. The dirty secret is that older equipment, the very equipment the seller is trying to offload, can push utility costs above 20% of gross revenue, and in some cases, higher. A Reddit user who operates 4 laundromats stated it plainly. The coin-op business itself literally does not cover the cost of electricity, gas, or water needed to run the machines. This is not hyperbole. It is a structural feature of the industry. The machines are designed to fail, and their failure mode is increased utility consumption, leaking water, drawing excess current, cycling inefficiently. The older the equipment, the more revenue evaporates into the utility bill, and the seller knows this. This is the central mechanism of the ownership trap in the laundromat industry. It is not a bug. It is not bad luck. It is the business model. Chuck Post, a laundromat consultant with 38 years of industry experience and author of the book The Laundromat, An American Dream Business and Entrepreneur's Playground, documented the cycle in detail. Laundromat industry standard models are designed to fail over a 12 to 15-year span, roughly the life expectancy of commercial laundry equipment. At year 9, the decline begins. Equipment failures accelerate, repair costs rise, customers encounter broken machines and leave. The store's reputation degrades, revenue ticks downward, then downward faster. The owner faces a choice: retool or sell. A full equipment retool, replacing every washer and dryer in a mid-size laundromat, costs $250,000 to $450,000. Chuck Post describes a common scenario. An investor purchases a laundromat for $150,000 and then discovers they must reinvest another $450,000 into equipment. That is a 300% capital call on an asset that was supposed to be generating passive income. But the trap has another layer. The broker values the business at 50 to 60 times monthly cash flow. That valuation is based on the peak earnings the store generated just before the decline became visible to a buyer, before the equipment failures, before the customer exodus, before the deferred maintenance catches up. The buyer pays a premium multiple on peak earnings, inherits declining equipment, and discovers the retool math only after closing. Consider a documented case study from BizBen's transaction database. An investor, let us call him the buyer, acquires a laundromat generating $18,000 in monthly gross revenue with a broker-reported cash flow of $6,500 per month. The purchase price, at 55 times monthly cash flow, $357,500. The buyer finances the acquisition with an SBA loan at 8% interest over 10 years, carrying a monthly payment of approximately $4,340. Within 6 months of closing, 3 facts surface that the seller's disclosure did not emphasize. First, the equipment is 9 years old and approaching the death spiral window. Second, the lease has 4 years remaining with no renewal option guaranteed, and the landlord has been increasing rent 5% annually. Third, the utility costs are running $4,800 per month, significantly higher than the $3,200 the seller's P&L suggested. The buyer's actual monthly economics: $18,000 in revenue, minus $4,800 in utilities, minus $3,600 in rent, minus $4,340 in loan service, minus $800 in maintenance and repairs. That leaves $4,460 before insurance, before property taxes, before an attendant if the buyer wants a day off. The broker advertised $6,500 in monthly cash flow. The buyer is receiving perhaps $2,000 for a business that required $357,500 in debt to acquire and will require another $300,000 in retooling within 3 years. The buyer cannot sell. The lease is weak. The equipment is aging. Buyers who understand the industry will offer at asset sale pricing, perhaps $50,000 for the equipment and leasehold. The buyer is trapped. Chuck Post's analysis is precise. These investors are stuck in this dilemma for several years. The laundromat is sold as a hands-off business. That is the entire pitch: coin-operated machines that collect money while you live your life. The reality is documented in extraordinary detail by actual owners. The escalation follows a predictable arc. You open, a machine breaks on day 3. The repair call is $95 for a $5 belt. Plus the machine is down for 2 days, losing $40 to $80 in revenue each day it sits dark. You learn to fix it yourself. But you have a day job, so now you are sneaking out at 11 a.m. to replace a belt in a laundromat across town. Then you realize the coin-op revenue alone will not cover the utilities, much less the loan payment. So you add wash and fold service. Now you need an attendant. The attendant costs $15 per hour. But the attendant alone cannot handle the volume, so you need a second attendant on weekends. Labor costs rise. Revenue rises, but margin does not. Then you install vending machines, an ATM, and you start selling detergent and laundry bags. Now you need a wholesale account, inventory tracking, a cash register, and sales tax remittance. Then you discover someone is not registering all the cash transactions. Now you need inventory controls. Then wash and fold demand plateaus, so you launch pickup and delivery. You need a driver and a van. Insurance on a commercial vehicle is $300 to $600 per month. The driver costs $18 per hour. The van costs $25,000. You are now running a logistics company, a retail operation, a repair business, and a vending route, and you bought a laundromat because it was supposed to be passive. One Reddit commenter who operates 4 locations summarized the progression with brutal clarity. You quickly realize you have no choice but to operate wash and fold just to cover basic business expenses. Then you realize you cannot afford to pay someone every time a machine breaks down. Expect one machine to be out of order on any given day. So you learn to be handy. Which means if you have a day job, you have to sneak out to go fix a machine. Then you realize you barely make a profit for all the headaches. This is not an outlier. This is the standard owner experience. The industry will tell you a laundromat is a 95% success rate business. That statistic circulates through every passive income blog and every broker's pitch deck. It is not false. It is simply incomplete. A laundromat does not fail in the traditional sense. It does not close its doors. It just stops generating meaningful returns while consuming all of the owner's available time and capital. That counts as still in business in the statistic. It does not count as wealthy. Here is the optimistic scenario. You purchase a well-maintained laundromat in a dense, low-income rental market for $350,000. You finance 75% with an SBA loan. Gross revenue is $22,000 per month. Utilities run $4,500. Rent is $3,200. Loan service is $3,100. Maintenance, insurance, and miscellaneous expenses consume another $2,000. You pay one part-time attendant $2,000 per month. Net income, $7,200 per month, or $86,400 annually. At that rate, you recoup your $87,500 down payment in roughly 14 months. Then, the equipment begins to age. Here is the realistic scenario. The same store, 3 years later. Equipment is now in year 10. Utility costs have risen to $5,800 per month as machines cycle less efficiently. Repair costs have doubled. Customers have noticed. 2 regulars have switched to a competitor that retooled last year. Revenue has slipped to $19,000. You are now netting $3,200 per month on an asset that requires a $300,000 reinvestment within 2 years. You are earning less than a shift manager at a well-run fast food franchise, and you worked 60 hours a week to do it. The laundromat is not a scam. It is a viable business for operators who understand the equipment cycle, who negotiate ironclad leases with renewal options, who budget for retooling from day one, and who accept that passive is a marketing term, not a description of the owner's daily reality. For everyone else, everyone who bought the 95% success rate statistic and the 30% ROI projection, the laundromat is a slow-motion capital consumption machine dressed as a small business. And the person selling it to you knows exactly when the clock runs out. If you want more elite insights like this, like the video, share it with others, and subscribe for powerful, high-level content consistently.